Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
All right, we're diving straight into Maison Solutions, Inc., ticker MSS. And this is one of the most extreme cases of, let's call it corporate schizophrenia that we've seen in the microcap space for a long time. It's a story about a specialty Asian grocery retailer, with real verifiable revenue that is simultaneously trying to pivot into a leveraged cryptocurrency holding company.
And the market's reaction to this dichotomy is not just violent. It's defining the company's entire existence right now. The stock is hovering around, 43 cents? It's down nearly 90% from its $4 IPO. To put that into perspective, the company's market cap is about $10.7 million. That's a tiny fraction of its reported annual revenue of over $124 million.
Which brings us right to the central question, doesn't it? Is this severe market discount a fair reflection of the entity's, yes, undeniably high-risk financial structure? Or is the market just fundamentally, maybe tragically, mispricing the success of its core retail operations? I'm going to argue that the underlying value is being completely ignored, just suffocated by all this financial noise.
And I'm going to maintain that the financial architecture and the frankly deep governance risks are so profound that they override any positive operational metric. They make that successful grocery business virtually inaccessible to an equity investor. That 43-cent price tag, it's not an inefficiency. It's a perfectly calculated warning label.
Okay, so let's start with the business itself. It's critical to establish what MSS is. It's a proven high-growth specialty grocery business in the defensive consumer staples sector. Their roll-up strategy, specifically the acquisition of Lili International Supermarkets, was a massive, documented success.
A successful roll-up, yes, but successful really only on the top line.
Well, it drove a staggering 114% year-over-year revenue increase to $124.22 million in fiscal year 2025. This isn't just, aspirational growth. It's substantial cash flow from real stores. And on top of that, they have a unique operational moat. They cater expertly to the Asian American demographic with a perishables-heavy, culturally specific inventory. We're talking live seafood, specialized produce, that mainstream grocers they can't handle it efficiently.
I agree the market they serve is robust, and the gross margin did improve to 21.3%. But that operational competence is being completely undermined by the need to fund this expansion. You say the liquidity crunch is a consequence of aggressive expansion. I'd call it a consequence of not having enough capital for that expansion in the first place.
I see the liquidity issue and the sub-dollar stock price as temporary, as consequences of front-loaded integration costs after that big acquisition. The core business is thriving, and management's pivot into leveraging, the digital asset space, specifically with Worldcoin, or WLD, is, I think, rationally framed. It's not just a desperate move.
I don't see how you can separate the business from the balance sheet. For a public microcap, that separation doesn't exist. The pivot into Worldcoin is a desperate maneuver. It has to be. It's driven by existential balance sheet stress. The company basically transformed overnight from a low-margin retailer into a highly leveraged crypto holding company, and did it without the capital structure or the governance checks to manage that kind of volatility.
But the strategic vision is there. The stated goal for holding WLD isn't just speculation. It's about solving real cross-border payment issues with international suppliers, which is a huge friction point in specialty grocery. And, critically, reducing loyalty fraud through World ID's Proof of Humanity application.
That's a compelling story, but let's look at the financial foundation they're building this on. The company is operating with a debt-to-equity ratio of 4.7. That's dangerous in any industry, let alone low-margin retail. And what's even more concerning is the current ratio of 0.58.
That 0.58 current ratio is certainly precarious, I'll give you that.
It's not just precarious, it's untenable. It means that for every dollar of immediate bills they have to pay, they only have 58 cents in liquid assets. That is a disaster waiting to happen. And on top of that, The small annual net income of $1.2 million is so volatile. I mean, just look at the Q1 fiscal 26 loss of -8 cents per share. That was a 700% miss.
That volatility on the income statement is expected during a major integration and a dramatic strategic pivot. Those are temporary headwinds.
I'm sorry, but I just don't buy that as temporary. And here's why. It's being compounded, if not entirely driven, by what we call death spiral financing. The $70 million for their digital asset treasury is coming almost entirely from convertible notes. And these notes are structured to be highly toxic and dilutive. They just continuously convert at a deep discount to the market price, which guarantees a perpetual mechanical downward pressure on the stock, no matter how many groceries they sell.
Right, and that structural selling is the core conflict that stops the market from seeing the underlying asset. So this brings us to our first major point. Operational value versus liquidity strain. You focus on the balance sheet, but I have to emphasize the asset itself. The business is a defensive consumer staple, backed by $124 million in revenue. This level of scale makes the business a deeply valuable asset, one that should be right for an acquisition, a classic scenario C exit, even if the public equity is distressed.
I agree that if you could cleanly separate the grocery business, it would be a desirable asset. But you can't. The balance sheet risk is the first thing any serious acquirer looks at. That 0.58 current ratio means MSS is profoundly struggling with working capital. So how can a valuable asset be serviced or integrated by an acquirer when the management is relying on these toxic financing structures just to stay listed on NASDAQ? That $70 million crypto debt is like a poison pill wrapped around the viable operating company.
But the market valuation is $10 million. A profitable, growing business with $124 million in revenue is worth multiples of that regardless of the debt. An acquirer could easily value the operational assets at $50 million, absorb the debt, and still profit by just stripping away the crypto gambit. You're suggesting the market has zero faith in management finding any alternative to dilution?
I'm suggesting the market has zero faith in John Shu, who controls over 90% of the voting power. This absolute control allows him to make unilateral, bet-the-company wagers without any real shareholder recourse. That governance risk just compounds the debt structure, and it confirms to the market that dilution is the path of least resistance for management, not the last resort. The value might be there, but the ability of an average shareholder to access it is blocked.
Okay, that takes us to point 2, the Worldcoin pivot itself. You call it pure leverage and desperate balance sheet engineering.
Yeah, I see it as balance sheet engineering designed to save the company, not a sound business strategy for long-term improvement. Investing $70 million, which is 5 to 7 times the company's current market cap, into a single highly volatile cryptocurrency like WLD is an extreme form of speculation. If WLD prices collapse, that forces massive impairment charges, which leads almost inevitably to technical insolvency given how thin their equity cushion is.
That is the risk. But that risk is proportionate to the potential reward and the threat they face. And I fundamentally disagree that it is purely financial engineering. It has a genuine, sophisticated strategic vision tied to retail utility. Let's talk about the retail pain point. Coupon fraud and loyalty abuse are rampant in the grocery sector.
I agree, but how does holding WLD solve that?
They intend to leverage World ID for proof of humanity. World ID uses biometric verification to establish that a user is a unique human. By integrating this into their loyalty program, MSS can ensure one verified human equals one loyalty account. This directly eliminates the massive coupon fraud that eats into their margins. It's a targeted technological solution to a very expensive, specific retail problem. And this offers the only non-dilutive path to potentially paying off that convertible debt.
It's a beautifully constructed theoretical strategy. But the fact is, they are tying the fate of a $124 million grocery business to the price of a single, highly speculative digital asset. The operational benefit is speculative and futuristic. The financial risk is immediate and confirmed in the S-1 filings. You are gambling the entire farm hoping to pay off the mortgage instead of just selling enough vegetables to cover the bills.
The market's perception of risk is clearly inflated, though, which brings us to point 3, the market microstructure.
this conflict between the mechanical dilution and speculative trading. While you focus on the systematic selling, we have to acknowledge the high volatility that defines this stock.
The volatility is a distraction.
I disagree. The stock's high volatility shows there's persistent demand for MSS as a trading vehicle. And I'll reiterate a key technical indicator. The cost to borrow shares has spiked to over 52%. That incredibly high fee indicates a scarcity of shares available to short, suggesting the market is positioned for a big volatility event, a potential short squeeze that brings in momentum chasers.
That's an interesting point, though. I would frame it differently. I'm not convinced because I think that misinterprets the source of the supply and the nature of the selling. The high CTB is really just an indicator of the tight effective float because of the controlling insider John Zhu. But the actual selling is fundamentally structural, not speculative.
Right, so explain that structural selling.
It's the mechanical hedging action of the convertible note holders. These firms don't care about the grocery business. They get deeply discounted shares from the company, and they immediately sell them to lock in their risk-free profit. And we see this in the data. High off-exchange volume, often hitting 30 to 40%, suggests the selling is happening quietly in dark pools. It masks the true supply being dumped on the market. So retail investors are betting against a systemic, guaranteed dilution pipeline.
And the volume data also suggests a lot of those retail traders might not even know what they're trading.
Exactly. There's a lot of anecdotal evidence that sentiment is artificially polluted because traders often mistake the ticker, MSS, for the technical analysis pattern, market structure shift. They're trading a chart pattern, not the fundamentals of Maison Solutions, Inc. The systemic selling is real. The squeeze thesis is largely an illusion built on confusion.
But the sheer existence of that retail volatility still creates real pressure for the short sellers trying to manage their positions.
It's noise in the face of an earthquake. Let's pivot to the final point, the inevitable fate here, the reverse split. The NASDAQ compliance deadline to get back over $1 is January 6, 2026. This guarantees the board has to announce a reverse stock split in late December. It's a binary, unavoidable event.
And while it's inevitable, we have to frame it as a necessary structural defense, not just a desperate measure. The board's authorization is impressively wide, up to 1 for 100. This gives them the flexibility to create a significant post-split buffer, for instance, to get to a $40 post-split price, which would help combat short-selling pressure and ensure they stay listed. Preserving access to institutional capital markets is crucial for them.
That's the optimistic path. Historically, aggressive reverse splits are liquidation events for small, long-term investors. And we should clarify the odd lot problem for listeners because it's critical here.
Yeah, please do.
So if an investor holds, say, 75 shares of a stock, and the company does a 1 for 100 reverse split, they're left with 0.75 fractional shares. Brokerages can't hold those, so they forcibly cash them out at whatever the market price is. This completely liquidates small investors and guarantees them a capital loss, often at the worst possible time. The clock is ticking down to zero for a huge portion of the retail base, regardless of the core business health.
The board is clearly aware of that outcome, but they're making a choice to preserve the integrity of the institution and its ability to raise capital. If the company delists, the stock becomes a true pink sheet disaster and loses all liquidity. So the reverse split, despite the immediate pain, it preserves the institutional access that is their only long-term lifeline.
It may be the final lifeline, but it also signals the culmination of the risk structure we've been talking about this whole time. The market knows this is coming, and that knowledge is baked right into the price.
So to summarize my position, the fundamental operational asset, a high-growth, specialty $124 million revenue grocery business, it exists, and it has immense intrinsic value that's being ignored. The path to preserving any equity value relies either on the success of the Worldcoin treasury or, more likely, an acquisition of the operational assets by a competitor. The market is blinded by short-term balance sheet fear.
And to summarize my position, the current 43-cent valuation is dictated solely by financial structure, not operational success. As long as that convertible debt acts as a confirmed death spiral dilution engine and the threat of delisting and a reverse split looms, the risk of total capital destruction for equity holders is extreme. They are positioned behind a massive debt wall. The reality of the company's public market identity simply overrides the success of its grocery shelves every single time.
It really is a phenomenal example of where expert analysis has to rigorously separate the real-world business from the aggressive mechanics of its public market identity. There's clearly a lot more to explore here in the convergence of retail sentiment, financial structure, and operational reality in this very unique company.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.